Hi, we're going to do a review today for the final in MBA 610, which is our management finance class here at St. Bonaventure University. So, a few of the things we did this year, just a very brief outline I threw together. We started off with the review of the financial system, and as you know, financial system is surplus spending units and how money flows from surplus spending units to deficit spending units and back. We spent a lot of time on that at the very beginning of the year. It was right after our trip to, my trip to Haiti, and we spent a lot of time talking about how their system was lacking surplus spending units. We definitely did quite a bit on that. Then we talked about REM behavior, and REM behavior was a model of human nature and how people behaved. Short version is that we are maximizers, we're resourceful, and we try to maximize our own utility. That does not mean that we're hurting other people necessarily, because in many cases helping them is also helping us, but it does mean that we're in it for ourselves, we're looking out for each other, for ourselves very much. And that led into the nexus of contracts model. Nexus of contracts model is something very common that we talk about all the different stakeholders. And there's lots of different stakeholders. There's shareholders, there's bondholders, there's employees, there's management, etc. And there's all of these other employees and stakeholders and community. And we all have a vested interest in the firm. However, we concluded that most of the time shareholders were the most important group. And the reason was not because they were nicer, not because of anything other than the fact that they were in the best position to monitor. And they were the people that monitored more than anyone else. Now, when we talk about this, we also spend a lot of time at that point talking about ethics and why it is important to treat everyone in this nexus as at least a winner. It is all win-win. Think win-win. We watched several videos. We talked about that the idea here is that if someone is not happy, they are going to make the whole thing fall apart. So whether it's the employees, whether it's the bondholders, whether it's management, or whether it's shareholders, we all have, or the community, we all have a vested stake in this, and we do have to think long-term, and we have to think win-win. We talked about the example of you wouldn't want to work for a company that was dumping toxic waste in the river. Clearly, it might make sense for the manager to do so in the short run, but thinking long-term, that's not going to be a good plan. So we talked quite a bit about that. We talked about the importance of contracts in lots of ways. We talked about organizational forms. We talked about proprietorships and partnerships and corporations. We talked about different types of corporations. So all of that stuff within the nexus of contracts model. Concluding with, again, shareholders most important because most of the time they're monitoring. We also talked about how incentives could be mixed up if firms had a lot of debt, and in that case we probably want to put bondholders in charge, and that's what we see in bankruptcy, where we're looking out for creditors, we're not looking out for bondholders. So, we're not looking out for shareholders, I'm sorry. So all of this stuff was sort of preliminary but very big foundation for the entire class. After that point, we took a little, a little tack away from this, and we started talking about time value of money. We talked about present value, we talked about future value. I'll review most cases from some other class that you've had at undergrad or anywhere else, but then we applied it. We talked about personal finances and how it was so important. If you remember, we had a homework assignment, how it's so important to start saving early. And the longer you save, the more frequently you save, the better off you're going to be. So start as soon as you can. Put money aside. Do it on a regular basis. Do it on a tax-preferred basis, etc. We talked about all those things. We also talked a little about doing it on the business side. We had a couple problems, etc., where you're doing homework. You're trying to set aside enough money to do a purchase later on in the year. And the big case, however, is in investments. We're talking about what type of investments to buy. This clearly led to valuation. We started off with bond valuation, fixed income. It's easier because we have a contract that's laying out when the cash flows should, not necessarily do, but should occur. And we made a big point about yield to maturities in companies that may not make where there's high default risk, junk bonds, etc. yield to maturity overstates the realized return in many cases. So just be careful about that. We talked a lot about fixed income. Then we got into stocks. And stocks, I still maintain, that pricing stocks is probably the most difficult thing to do in finance, because we don't have a crystal ball. We don't know what the future cash flows will be. We know theoretically we are going to price stocks using discounted cash flow valuation, looking at free cash that's available to shareholders and seeing what they can pay back. But we also know that it's very difficult, and we're forecasting sales and we're forecasting expenses, and we really don't know an awful lot about this. So we try, a lot of assumptions go into it, but it is a difficult theoretical thing to do. Because of that, we often use market multiples, or comparables as they're often called. And these are such things as, how do we compare to other companies in our industry? For instance, how's our PE ratio relative to their PE ratio? How's our market to book to their market to book, etc. These work really well if everything else is the same, but clearly they're not. Some companies may be more aggressive in realizing earnings. Some companies may be depreciating quicker, whatever. And it does change. We have to use all of these multiples, all of these comparables with a grain of salt. We have to interpret them. We can't just blindly follow them. We also talked at this point about some, I guess I've left it out here, some portfolio math. Portfolio math, such things as standard deviations of portfolios, expected returns of portfolios. And that got into a little history as well, but we'll touch that later. At that point, we made a quick change into capital budgeting. And the reason we do it here is because really capital budgeting is the same as valuing stocks or bonds. It's net present value analysis. It's the same. You're just comparing it. Is it worth buying? Is it not worth buying? Net present value is by far my favorite. There are other ones we talked about. We talked about yield. We talked about internal rate of return. We talked about payback periods. We talked about even how some companies, I wouldn't recommend it, but some companies use EVA and such things as average accounting returns. And we talked about the problems that all of those had. Then we got into looking at what is the correct discount rate to be using to do these calculations. And we said, well, we understand we can't use weighted average cost of capital for capital budgeting, because what would end up happening is that we would end up accepting riskier and riskier projects. Here's the weighted average cost of capital line. This should be the true line. And we would be rejecting these and accepting these, and that's not a good mix. So you always want to get the discount rate that corresponds to that project or to that firm. So to do that, we took a step back and looked at a little history. We talked about the realized returns historically from as far back, in some cases we went back into the 1800s, and we said basically that we had low-risk treasury bills and things down here, we had bonds, we had large stocks, S&P 500, etc. Further up we had small stocks up here. So it wasn't exactly a straight line, but this basic idea holds. We have standard deviation here, and we have returns here. And this is pretty much true across lots of different time periods. How steep it is, etc., changes, lots of different countries. But the basic idea, more risk, more return, always holds. And we understand that. We talked about the theory. We talked about Markowitz and diversification. And what we want to do is applying portfolio math and applying standard deviations of portfolios. We want to get as close to up here to Seattle, if you will, in our language, because it gets us to higher and higher indifference curves. So the lower the correlation between investments, the closer we're going to get, the more bend in this investment opportunity frontier, and it'll get us to a higher indifference curve. And then we introduced a risk-free rate, and we talked about the capital market line, and then we changed it, and we said, okay, well, this capital market line might, this is the market portfolio, and this is standard deviation. Let's go ahead and change it, and we led into the security market line. And the security market line, we had beta down here. And we talked a lot about CAPM. And we spent an awful lot of time on CAPM, even though the model has sort of been disproven. And the reason, as you remember from the first exam, the reason we spent so much time on that is because it really laid the groundwork. It showed that systematic risk is what is important, and that systematic risk is always going to be what is important in pricing stocks. And all of the new methods, whether it's FAMA French, I wrote down here, or APT, or whoever knows, consumption-based CAPM, intertemporal CAPM, any of the other models that we're talking about, all have at their center systematic risk. We can argue until the cows come home about what's the correct measure of systematic risk. But no one, very, very few people at least, are still saying that systematic risk doesn't matter. And I think that we all agree to that. That wrapped up the first test. Everything up to there was on the first test. For the second test, we got into market efficiency. For the final, we talked a lot about market efficiency. We did some really cool examples with the space shuttle and whether with the Titanic, etc. Basic idea is that markets respond through trading, and trading drives prices. And everyone has a little bit of information. Remember from the Wisdom of Crowds video, we talked about the idea that every trade has some information, some info, and some noise. And what we want to do is we want to sum up over many trades, I equals 1 to n, where n is the number of traders that we have. And this noise term, if, gigantic if this noise term is distributed around 0 and is independent from each other, each trader is independent, then we're left with only information, and prices will reflect full available information. However, there are limits to this. We can't necessarily trade. For instance, if we say no short selling, or if we say no insider selling, all of a sudden we have some issues with allowing all the traders to participate. Moreover, and probably more importantly, traders are not independent. They all look at each other. We get into mindsets. Oh, gee, I see what they did. I'm going to copy them. And it led very quickly to the idea that maybe some of the times we have correlations between these, and we can't just arbitrarily drop this as n approaches infinity. We did show this, and we showed that, generally speaking, passive investing beats active investing. And that seems to be a problem for Wall Street, because it's easy to do. We can all do it. It's cheap. And we tend to beat the market. We beat active investors if we do it. So why don't more of us do it? And then we led into behavioral finance. And one of the reasons we don't do it is because it's not as fun. Passive investing is boring, and picking stocks is fun, and being able to brag about. And that led to a whole discussion on behavioral finance. We spent several weeks on that. It was one of the topics that most of the students really enjoyed. We looked at it from lots of different perspectives. We started off with the Dan Ariely case where, the videos where you show that even though we know something, we still fall for it. Even though we know the Rubik's Cube he showed, where the colors were yellow and brown or whatever they were, we know when we switched it, when we blocked it out, we still fell for that problem. And even though we had a large portion of our brain, we still fell for these color scheme issues. And we saw that defaults matter. And we did that with the case of organ donation. And we saw how having an inferior option may change your decision. So all of these things are irrational at some level. We talked a lot about the idea that, you can no longer just assume, well, money's at stake, people are going to do what's in their own best interest. We see that all the time. Defaults matter, and inertia is really a big type of default, and people anchor on weird things, and you want to fit in. All of these things are really behavioral at heart, and again, behavioral is sort of the marriage of psychology and finance, and it really does matter. Some of it is irrational, some of it maybe we just can't explain yet. I don't know. We showed several monkey videos. We showed the importance of having patience and thinking long term, again here with the marshmallow example, and then looking at returns. We talked about prospect theory and why we trade so much, why we get out of stocks when, at the bottom we sell out because we think the bottom is going to fall out, and we're buying at the very top. And because of that, average return on the market is around 12. Average return on an actively invested mutual fund is around 9. But the average investor only earns 6 because we're doing these things that are, at least at their heart, irrational. And we talked a lot about the market efficiency hypothesis, which I sort of left out of here, and the idea that markets are always efficient and today's price reflects all available information. And then we talked about bubbles, and we showed that sometimes we can pick bubbles. So this idea that the market efficiency hypothesis is gospel is sort of falling by the wayside. Still an awful lot of truth to it, but it's not absolutely 100% true all the time. For instance, Schiller and others have showed that if you look at PE ratios at the top of market cycles tend to be much higher than at the bottom. And if you buy when the market is at a peak, when PE ratios are high, over the next 10 years, you can have a lower than long-run average return. That led into the next behavioral topic, which was sort of a behavioral, clearly a psychology, so we can call it a behavioral finance. It's not irrational. It's explaining more deeply why people behave as they do. And we looked at neuroscience, and we literally took some time out. We got out of finance for a second, and we looked at EEGs, and we looked at blood tests, and we looked at fMRI machines, and we looked at machines that were designed to look at how the brain operates and how we think. And what we saw was that we can, in fact, become addicted to risk. We like risk, we can take risks, but we also like other things. We like helping people. It explains charities, oxytocin. It explains fairness. The whole Paul Zak video with the moral molecule was in there. Many other things. And this, like I said, I think was probably, if I had to pick that section, that's 3 or 4 weeks, were probably everyone's favorite part of the year. We talked about from market efficiency to behavioral finance. It seemed to be that everyone was really enjoying that portion. Then we got into insider trading and front running. Ironically enough, front running came to the front. Had to laugh. With the Flash Boys, that was out, the video that was on 60 Minutes and everywhere else that week, Daily Show, etc. And we looked at, is insider trading, all insider trading is not illegal, some is, and what makes the difference? And if you're trading on proprietary information, non-public material information, you shouldn't be doing that. And the SEC will try to crack down on you. Sometimes it doesn't, sometimes it doesn't. We saw the case with Mark Cuban, where he was accused of trading in insider information. A jury subsequently has acquitted him. So there's no absolute here. My biggest case and my biggest point would always be to fall back on reputation matters. And even in the case, we saw some videos and presentations that Martha Stewart and others that did things that were seemingly very illegal and that they took home a very little amount of money. It's not worth it. That would be my biggest piece of advice. It's not worth it. So at that point, we made another switch, and we got into capital structure. And just so you know, there's insider trading. There's a lot of links to cases on the page, international as well as domestic. One of the cases I think that most people got really upset with was looking at what Congress used to be able to do. Some say they still do. You might want to watch that again just quickly. Got back to capital structure then. We talked a lot about what capital structure is. We talked about it being the right-hand side of the balance sheet. If we're thinking of a normal T account, we're looking at the mixture between debt and equity. We talked a lot about, and the book talks a lot about different types of debt, whether it's normal straight coupon debt, whether it's convertible, whether it's floating rate, whether it's puttable, callable, etc., etc. You are responsible for all those, and you should know them. But they're really easy. I'm not going to read to you. I'm not going to bore you to tears reading something that you can do for yourself. So please, go ahead and read that. I don't think you'll have any problems with those. I did throw some notes up there as well. Other things here. We then spent a lot of time talking about the implications or the consequences of debt. Summarized in my famous saying, debt makes good times great and bad times horrible. It is a magnifier. It is just going to make, if things are going pretty well, it's going to make them really good, measured by return on equity, and if things are going bad, it's going to make them really bad, because you always have to make those fixed payments out. So we talked a lot about that with respect to leverage. Then we talked about Modigliani and Miller, and we started with the Yogi Berra example with a pizza, where how you slice up the company's cash flows doesn't matter in their world. I would definitely understand the assumptions that led to that. That's very important. Modigliani and Miller's assumptions: perfect markets, no information costs, no transaction costs, no taxes, no fixed investment opportunity front. In my language, left-hand side equals right-hand side. All of those things matter. And in fact, under those assumptions, very little matters. Marketing doesn't matter, dividend policy, executive compensation, very, very little matters in their world. But we do not live in their world. And we see there are corporate taxes, and people do behave differently, and we can't costlessly liquidate in the event of a bankruptcy. So we saw that capital structure does matter, and that firms have some optimal range that they would like to trade in. That they would like to have, not traded, they would like to have this much leverage, whatever this is, right? This optimal range. And it varies by type of company. Some companies might have a very risky business model and you want to have less debt, whereas a company with a very stable business might want to have more debt. And their type of assets matter. And all of those things we went into. We spent the better part of a week and a half talking about capital structure. So look back through that section. 2 points to remember. One, you always want to make sure you're looking at the business risk first. You don't want to just take on a lot of debt arbitrarily. Business risk matters. Financial risk matters. You don't want to add both of them on top of each other. The second is try to match the duration of your assets with the duration of your liabilities. You don't want to constantly be financing long-term assets with short-term debt that you have to roll over. Not only because interest rates could go up, but also one downtime and you're out of business. You can't roll it over once and all of a sudden you're in trouble. And markets are not as perfect as we like to think. We saw that in 2008 and 2009 when the primary markets in the United States, the most liquid market in the world, the primary markets in the United States seized up. And they were you could not raise new equity, you could not raise new debt very easily. There was a credit crunch. Didn't think that could happen? Well, it does. We also talked a little about the problems of over-leveraging looking after disasters. Companies after the global financial crisis that went into it with a little more flexibility came out quicker. We saw the same thing after Katrina. We saw the same thing in Japan after their earthquake, tsunami, radiation event. So you don't want to maximize things to the tilt. At this point, this optimization, this anti-optimization method, I guess, we talked a little about Anti-Fragile by Nassim Taleb. Highly recommend watching a video on that. It's a quick one. It's a good one to look over. So that was sort of that portion. We then talked about changing the capital structure. We talked about the pecking order versus the trade-off theory or the trade-off hypothesis. And we sort of concluded in the end that firms do use the trade-off hypothesis, and we know that because there is a target capital structure. And if they vary away from it, they tend to come back to it relatively quickly. There's quite a few studies that have shown that. However, they also get involved with market timing. Market timing works as well. I mean, it doesn't work. It is an issue as well. And managers do try to time the market. When interest rates are low, they issue long-term debt. When stock markets are high, they issue equity. So it's not an absolute fast, this is the way you do it, but this is how we want to do it, and we're going to look around and see the environment. And since we are REMs, we're going to change our behavior to fit the environment. We then talked about the reverse. Instead of raising money, we talked about, oh, I messed one up. I forgot. We also here talked about IPOs and seasoned equity offers. Sorry about that. IPOs and seasoned equity offers. We talked about the problems with underpricing and why companies would leave so much money on the table. We looked at the history. We saw, the cycles that we have in the late 1990s when we had this bubble where many companies were going public. And then after 2001, 2002 period when very few companies were going public. And the cycle, and whether Sarbanes-Oxley increased the cost of doing business and on in public markets, and therefore kept some companies from going public and helped to spur the development of the private equity market. And we talked quite a bit about private equity at this point. And the growth of the industry, as well as all of a sudden now we have many large companies. Before they were small, many large companies now being privately held and not needing to go to the capital markets every single quarter with their earnings, etc. So it's an interesting dynamic that has occurred, and would love to spend more time, but we didn't have more time. So we went on to dividends and buybacks. And that was the reverse. Instead of getting money, which we've been talking about, or reinvesting money at the firm, right, at this DSU firm level basis, now what we were talking about is giving money back. And how do we give money back? And why do we give money back? And we talked about dividends, and we talked about interest, and we talked about buybacks. Dividends and buybacks were the two big ones, obviously, for equity holders. We talked about the signaling aspect of dividends. We talked about how they had fallen out of favor. And all of a sudden, around the time of Enron, they came back in favor dramatically. And we talked about the tax implications of dividends. And dividends are double taxed and all of that. And then we talked about buybacks and the flexibility that they give management and whether that's good or bad. And it is both. I can't tell you what's good or bad. It's less of a signal, but it does give managers more flexibility. We then talked quickly about governance, and we talked about governance actually throughout the whole year. Governance, looking at boards of directors and the makeup of boards of directors and what they're supposed to be doing. And we clearly want them looking out for shareholders, but they don't always do that. And why? Sometimes, it might be that they're sitting on the board and you're sitting on my board, and I'm not worried about. I'm not going to really be tough on you as a CEO because I want you to be tough on me. You scratch my back, I scratch yours. But it also other problems. Right? It's very difficult for an outsider to get elected to the board. The company, whoever management recommends, gets reelected most of the time. So that becomes a real issue as well. If the governance fails completely, we end up having our stock price drop and we become a target for a takeover. And what happens is that leads to the market for corporate control. And we talked a little about the different types of takeovers, the mergers, the acquisitions. We also talked about divestitures and spin-offs, vertical deals and horizontal deals we talked a little about. Again, not enough time to do it justice, but the idea here is that this is sort of the last form of corporate control that we have, short of going to the government and government ruling, making rules and regulations to prevent things. Within this, we also talked a little, and there's notes online, about why companies might not want to be taken over. Short version, managers lose their jobs very often. And when they do, they fight it too much sometimes. So what we do is we give them golden parachutes. We give them platinum parachutes. We give them all of these defenses, takeover defenses. Then we hope they don't use them too much. And the evidence is mixed there. But it does appear that occasionally giving poison pills, etc., does drive up the value, the premium. However, as a rule, I am not a fan at all of a poison pill. I think it hurts shareholders more than it helps shareholders. So, and finally, we ended the year very, very briefly talking about derivatives. Again, we had talked about them repeatedly throughout the year. The idea that we can use, derivatives to hedge and be careful with them. But they're great tools, but be careful. Like chainsaws. Used correctly, they are going to make a lot of difference. Used incorrectly, you're going to get hurt really bad. And you may lose an arm and a leg in a chainsaw, but you may also lose your company in derivatives. And we talked about some of the big ones that went up. We talked about, obviously, Barings Bank, and that's probably one of the most famous ones back from Rogue Trader back in the 90s. But it's still, video, watch the video, it's a good one. We talked about the whole global financial meltdown and looking at how derivatives got so exotic that some people didn't understand what they were trading. And they got hurt very badly for it. So that's a review of the year that we had this year. I hope you enjoyed it. I definitely did. I thought it was a good course. I know we went fast here, but there was a lot of material. And I guess to summarize, I would say markets are tough to beat. They're not perfectly efficient. People behave rationally most of the time, but not always. And that's what makes finance so cool. There's oftentimes no absolute right answer. And when we're looking into the crystal ball, when we're hoping that we know what the price of the stock is or how much debt we should have, we really don't. And there's and that's a good thing too, because if we did, if we knew it, they wouldn't need us. We'd have computers replace us all. So understand the risks of when you do something, increase transparency to improve governance, realize that people are not always rational, and realize debt makes good times great and bad times horrible, and you'll probably be okay for the final. So good luck.